First, let's go to the latest on the markets. Another bizarre week of shutdowns, but the government's JobKeeper package has been, got to say, essential to keeping that vital connection between business and employees. Joining us live from Melbourne, Evan Lucas from InvestSMART. Evan, would you agree with that? Is the market optimistic about JobKeeper?
Yeah, I would. And look, we probably saw the initial reaction to that last Friday, and then throughout the week, we actually continue to see a slowing down of the volatility inside the ASX particularly. So I think what I've been saying with the whole scenario around this is that until we start to see volatility go back to sort of, I wouldn't say normal levels, but half what we saw probably 2 weeks ago when they got to some of the highest levels you've ever seen, even including the GFC, that would sustain that. I think also you can't deny that when economists, particularly somebody like Bill Evans this week, came out and said that it's obviously going to halve the unemployment probability from about 17% in his estimates to about 9%. And there was more analysts that basically said along it's probably more likely going to see it between now 7 and as high as 11% rather than in the good high teens numbers. It does reduce that. However, in saying that, you still need to look very clearly that there are specific areas of the economy that are going to be not only under pressure but actually shut for the foreseeable future. You've seen the Prime Minister himself this week starting to talk about possibly 9 months rather than 6 or 3. And all of that just led towards the back end of the week being a little bit more volatile. But the JobKeeper program certainly has calmed down the markets and certainly has calmed down the big risk that was facing the economy, which is a huge loss of employment.
What about the news around oil and oil prices and a possible deal? How's the market taking that, Evan?
Again, you need to look at it was not even about the deal, it was about a tweet coming out from the president, wasn't it, in terms of what he said and the cut between 10 and 15 million barrels of oil from Saudi Arabia and also Russia. He's got a vested interest to say this, don't forget. He has and is the largest producer of oil at the moment. The US and their shale gas industry has been absolutely booming before the whole issue around COVID-19 came. Part of the reason we had this sort of fallout between Saudi Arabia and Russia is that Russia saw this as an opportunity to pressure US gas players and US oil shale gas players with lower prices. Now, it's not surprising that Saudi Arabia is going to back off because it's actually physically hurting them to pull oil out of the ground. Whether or not it's the 10 million barrels or 15 million barrels that the president announced in his tweet and then when he did this press conference remains to be seen, but it is likely to see some form of cut. The market has come well back from what it originally did. So it was up at one point, 35% record all-time movement upwards in oil, finished at around about 18% higher. So the market believes that's certainly going to help.
So a developing story this week has also been about dividends, particularly bank dividends around the world, with regulators basically saying that banks are not to be handing out dividends or doing any kind of share buybacks at this time. Now, that hasn't happened yet in Australia, although the RBNZ stopped our big four subsidiaries paying dividends back to our big banks. Where do you think this is going to go with banks and indeed other companies?
Your word there is yet, in terms of what your question was, and I think that needs to be pointed out. So let's look at APRA. They have already said that they want Australian banks to be unquestionably strong. That is their wording. They, therefore, are seriously giving this a good look. We know that Tier 1 capital at the Big Four is pretty good, but in a current scenario like this, it's probably likely they want it to be even stronger. There's 3 parts to this. Regulation you've just highlighted, and the Bank of England and the RBNZ have said that they do not want any dividends paid out, and APRA is part of that. Second part of this, the government is talking about spreading the pain. We know the banks are being asked to defer payments, to find ways to reduce mortgages, to do other sort of areas around repayments for their customers. And the third one is just general operations. We've already seen the housing market really fall away in the last 2 weeks. Numbers that we saw over the weekend were the lowest I've seen for around about 18 months. So normal operations of new loans, new business loans, etc., isn't coming either. So naturally, that's going to put dividends on the downside. Whether or not they go to zero, I'm unsure that they might go that low, but I suspect that it will be at least half, maybe even a quarter of what we've been seeing over the last 3 years. And we already saw NAB at the back end of the first quarter of FY20, move by 16 cents. So do not be surprised dividends get lower. Whether or not we go down to a freeze like the RBNZ and the Bank of England have requested, different story. But dividends will be lower. That's the most likely conclusion and the correct conclusion.
In a word, tomorrow, up or down for the market?
Probably down. We saw the US markets easing, and therefore I suspect that we will too. Well, as I said, the one thing that has been a little bit more confident, we are starting to see the volatility just drop away a bit. We're not moving huge percentage points per day. We're just moving 1 or 2 percentage points per day. Still not normal stuff, but at least it's better.